All right, well, it's top of the hour, so I'm just going to go ahead and get started on this. And first, this is really one of our favorite things that we do here at the Wealth Stewards. We love getting together quarterly with all of our clients. We definitely encourage you, throughout this session to consider questions that you might have. We'll touch on the agenda here momentarily, but we do have time for Q&A at the end. There's been a lot happening in the world lately, so we expect you to have some questions for sure. And we're also, for those of you that might have some friends or other folks that are interested in seeing what our comments are around this, we are recording this session, and we'll be passing out a recording or emailing it to you rather as once we get done, and probably tomorrow or the next day after that. And with that, I'm going to touch on the agenda that we've got scheduled for you today. So first, we've got a new hire here, Cyrus Baravati. I'm going to let him welcome himself, and we're going to start with that. Second, we've got a few developing market trends that we first saw back in January that we shared with you, and we want to give you an update in terms of how that's developing in real time. I'm going to turn it over to Ryan. He's going to talk about the impact of tariffs. That has probably been the massive news driver that we've had in the last 3 or 4 weeks or so. Then we're going to kick it back to Jeff, and he's going to talk about why it's important, even during these very volatile times, to stay invested. Then we're going to take some time and discuss something I think is very important to us moving forward here at the Wealth Stewards, and that's enhancing our private market offerings. And then we're going to open it up to Q&A. In terms of Q&A, you've each got a tab lower left. It's a chat tab. As you load questions into that, we'll make sure we address those towards the end of the session here. But with that, I'm going to turn it over to Cyrus. And please, join us in welcoming Cyrus Baravati. He's got a fantastic history in this business, and I'm looking forward to introducing you all to him. And Cyrus, are you with us?
Can you hear me okay?
Yes, we can.
Excellent. Well, thank you. Again, my name is Cyrus Baravati. I am so excited to be a part of this incredible team. I just wanted to take a couple of minutes to share a little bit more about me. I always knew growing up that I wanted to be a math teacher. I got my degree in applied math, went to school to get my teaching credentials, but it didn't take long for me to realize that public high school math teaching wasn't the glamorous career that I dreamed it would be. So it was then that I decided to make the change to the financial services industry. With roughly 3 years on the banking side, 2 on the broker dealer side, and a decade of experience as an investment advisor, I feel like I found what I was really supposed to be doing all along. I'm able to utilize my math background when it comes to portfolio construction, investment analysis, but math is really all about problem solving. And that's a major part of what I've been doing with my clients. I'm able to couple that with something that I'm still really passionate about, which is education. Not just why are we investing a certain way, but from a financial planning perspective, going through the different options, pros and cons of each to help my clients feel comfortable that they're making the best decision for them. Educating the next generation to ensure the transfer of wealth goes smoothly is also important to me. And I've even had the pleasure to teach financial literacy in some local schools here in the Phoenix area, such as Brophy and Camelback High School. I spent the last 6 years as an advisor focusing on ultra high net worth clients, coordinating with CPAs, estate attorneys, and insurance professionals to make sure that each part of a client's financial picture is in good shape, with a really big emphasis on tax and estate planning. To that note, I'm a certified financial planner, a certified wealth strategist, and a certified private wealth advisor. I'm really excited to be able to bring everything I've learned to the Wealth Stewards while also getting to learn so much from this incredible team. I've actually had the pleasure of knowing Ryan for over a decade and have so much respect for him, both personally and professionally. So when he shared with me his excitement about joining up with Brent and Jeff and how they've really taken the client experience to the next level, I felt like joining this team was too good of an opportunity to pass up. From a personal standpoint, you'll see right there, that's my whole world. My beautiful wife, Kylie, our 3 kids. Oliver, the oldest, turns 5 in a month. Our daughter, Florence, just turned 2. And our newest addition, Shiloh, is 4 months old. So we spend most of our time at this point in our lives just trying to keep our head above water. But otherwise, we enjoy being involved in our church, traveling, and hiking. Again, I'm so grateful to be a part of this amazing team, and I look forward to meeting many of you either in the office or at future events.
Thank you, Cyrus. I appreciate that. And as time continues and progresses, you're going to hear a lot more from Cyrus. I mean, he's very, I guess, incredibly talented and gifted in a lot of different ways, and we're really looking forward to sharing his expertise with the rest of our clients and the rest of the team here. And so with that, let's talk a little bit about the markets here. So we talked about back in January when we met some developing market trends that we might have seen begin to happen and how we made some very large adjustments to our portfolios accordingly. To those of you that are listening, that are clients, you'll recognize that we probably did the largest rebalances that we have ever done in history in the end of Q4 and into Q1. And it was based on some information that we're looking at the time that we didn't quite realize was going to be stress tested as quickly as it was. And so I'm going to talk about a few of those developing trends. And so last quarter in January, if you do go back and look at that recording, we talked about the unprecedented concentration in the S&P 500. And what I mean is this, the top 10 stocks in the S&P 500. So basically there's give or take any given time about 500 stocks in the S&P 500. The top 10 stocks comprised about 40% of the value of that index. And that's a level of concentration in the markets that we had just never ever seen in the past. I mean, if you're looking at this chart here on the left-hand side, even during the dot-com bubble, 26, 27% of the S&P 500 was made up of those top 10 stocks. We hit 40% towards the tail end of last year. So think, your Nvidia, your Alphabet, your Meta, those stocks were really driving the performance of the S&P 500. It kind of becomes unsustainable. And if you're simply invested in the S&P 500, it also presents a great amount of concentration risk. So that was something that we were looking at very closely. The other thing that we were looking at was the relative outperformance, or really extreme outperformance, of US investments over the last, really since the financial crisis, versus the rest of the world. Now, when you're looking at this chart, all you really need to consider is this. This is going back to 1950. So we've got a lot of data here. This dashed red line would be something we consider normal in terms of the price of US equities versus their international counterparts. If that line is going up, that means that US stocks are getting expensive. You saw at the tail end of the bull market in the 1960s, at the top of the Nifty 50, US stocks very expensive relative to their international peers. What you saw then over the next 20 or so years was international markets becoming essentially outperforming versus US markets for a long period of time. And these imbalances can persist for a while. US markets took the leadership again up to the top of the dot-com bubble around 2000 or so. And then from 2000 to 2007, that's really the last time we saw this concentrated period of rather international outperformance relative to those US assets. What we've seen since the financial crisis has really been unprecedented, where you're seeing that US stocks specifically relative to international stocks, the outperformance has been so extreme that quite frankly, we can go back 75 years and we've never seen anything like it. We didn't feel that was really sustainable over a long period of time. So those of you that are clients, you know that we made a lot of changes to our portfolios. We cut our US exposure back really significantly, and that was in favor of some of the alternative investments that we're investing in now, and also international stocks. International stocks became a much larger percentage where we could of what we're investing in here at the Wealth Stewards. Now, this data is even more extreme now than when it was taken back on March 31st of 2025. But what you're looking at is this. On the left-hand side here, this is the MSCI EAFE in the light blue. So think about developed international markets. Think Europe, Japan. Think, we're not talking about emerging markets here. These markets, as of the end of March, were up about 6.9% year to date. S&P 500 was down about 4.3%. It's a pretty big positive divergence in favor of international assets. Now, if this data was accurate, you'd see something even more extreme. You'd see international stocks up about 9%, the S&P down about almost 6 prior to the close today, the NASDAQ down about 12. And so you're seeing a massive outperformance of international assets relative to the US counterparts. What we've also seen that's gone hand in hand with that is the Mag 7. We're calling it the Mag Drag, but the Mag 7 is basically 7 of those 10 large S&P 500 component stocks. Think Tesla, Nvidia, Alphabet, Amazon, Apple, Microsoft, Meta, that really drove performance of the S&P 500 as an index, have all gone the wrong way this year. As of the end of the month, Tesla down 35%, Nvidia down 19%. You can sort of go across the board with that. So these stocks that were really significantly holding up the S&P 500, and even probably in a more extreme way, the NASDAQ, are all going the wrong direction. And so we were concerned about that concentration that we had coming into the year. We did a lot of things that we could to mitigate that. We also thought that international equity specifically were historically undervalued, so we made a big shift into that. And the results, even given a lot of the market volatility, has been extremely positive, quite frankly. So what we're going to look at now is none of our clients are some of you are perfectly aligned to our models. But in IRAs and other accounts where we don't have really big tax considerations, it's been easier to do this. But I want you to look at these year-to-date numbers, and these are targeted sleeves for us. So everybody might look a little bit different. But in a year where the Nasdaq is down about 12% year to date, and the S&P is down almost 6. Our most aggressive model, because of the incorporation we have of international securities, is down about 4.1%. Our most conservative model is up about 1.2%. Most of our clients, if you're on and you're listening, most of you are living right in here. You're down about that, maybe down 1% to 3% in an extremely volatile time here. I've had a lot of meetings with clients over the last couple of weeks, and I had one just last week where we're out to dinner. And after sort of, we had a drink before dinner, the appetizers are coming. And my question to the clients was, have you had a chance to look at your accounts so far this year? And the answer that I got back was no, we actually really don't want to, because in this case, 401k, which we do not manage, was down about 15% or so. Their accounts were down about 3. So far, far better given the really unprecedented volatility we've seen in the last 3 weeks or so, than for sure at least these clients were expecting. And a lot of that is definitely because of the very proactive changes that we made back in January. Now, one of the reasons, obviously, we've seen this significant volatility, the headline news right now is absolutely, it's pretty remarkable. It's really around the trade war that's occurring, and also tariffs. And so I'm going to turn this over to Ryan Reming right now, and he's going to talk about trade war, tariffs, what this might mean to the markets, and what some of the things are that we're looking at around this topic.
Awesome. Thanks, Brent. Yeah, so this is breaking news. I'm sure you have not heard anything yet about tariffs. So just brace yourself, okay? Yeah, we've had way more in this front than we expected, than anyone expected, than the market. And the way I know that is how quickly the market's having to price these things in, seeing these wild moves day to day. And it's unnerving for a lot of people, right? And so when you're watching those things and you're wondering what's happening, important to know that this is something that we talked about again in January, definitely been on our radar. And there's a lot of volatility that stems from this specific topic. And I don't have to explain any of that to you. It's on every single news story all day long. This is the new inflation, so get used to this. But what we wanted to do is kind of take a look at tariffs, and we've broken this into 4 outcomes that are desired outcomes, potential motivations for doing this. And so the administration is looking at these things for decoupling, and this is specific to China, looking at shifting supply chains long-term, reducing our resilience on specific countries. The other reason to do this is rebalancing, so trying to have reduction in our trade deficits, boosting domestic production. A third outcome that's targeted is for negotiating purposes, so using economic pressure to achieve policy outcomes. And then the final one is funding. So getting this revenue, because essentially tariffs are a tax. And so if they can generate funds, they can use those revenue generating tariffs to fund their budget priorities for this administration. And what's interesting is you've got, typically you see the entire administration working in unison towards the specific outcome. Part of the volatility we're seeing is you've got different segments within this same group. What seems like they're working towards different outcomes. And so that's been confusing for the market to price in. That's some of this volatility. And so this chart's fun. You look at days when Besant is headlining the news, markets are up a little bit. And then if it's Lutnick or Navarro, markets are down in a meaningful way. And so that's kind of just an easy way to look at this, and kind of understand that part of the reason we're seeing this volatility is because of that aspect of it. And then
Can I add one thing in that? Can I
Yeah.
add one thing into that, Ryan? And so is Treasury Secretary Besant, when he comes out, I think he gives very clear articulation about what the positives, negatives, what the outcome is, what the Trump administration is trying to do with these tariffs. Now, Lutnick and Navarro, these guys are really anti-China hawks. where everything tends to be extremely inflammatory. And I think the biggest takeaway from the two of these is that this economy, we learned this in 2020, and we've learned this throughout the course of the history of this country. It is unbelievably resilient. It's unbelievably adaptable. It's unbelievably creative. But what everyone wants to see from a business standpoint, and also from as a market participant, is you want some clarity of the message. Besant does a
Yep.
great job of giving a clarity of what's trying to be accomplished. Lutnick and Navarro, it's not just me saying it, the market's saying it, not so much. And you see this dramatic, the big down days tend to be when Lutnick and Navarro talk, and the big up days that we've had tend to be when Besant talks. So Ryan, I mean to interject on that, but I thought it was an important point to make.
No, that's a great point to make. Yeah, I think that that's pretty clear here in this graph. And the one thing the market hates more than anything is that uncertainty, right? And so not having clear messaging is critical in why you're seeing that. So thank you for making that point, Brent. You can jump to the next one. So I think, that's what we've been dealing with, what you're seeing, why it's happening. And I think it's important to go back and look 2018 when we had something similar, right? So the first round of these things, when we were targeting with China, initial trade war with China, market volatility picked up. You had a lot of similar things happening, but the final outcome of that year, we were pretty much flat on the year in terms of performance for the S&P 500. The following year, though, you're up 31%. So, like you were saying, Brent, the market is resilient. This is only one aspect of this. These companies are making the adjustments needed and navigating this well. And so we would expect moving forward, there's going to be a resolution here, and the market's going to be able to weather this storm as well. So really, what you want to do. You don't want to make emotional decisions when you're dealing with this type of volatility. It's just managing the volatility. We made adjustments coming into the year that have been doing well to manage that volatility. We'll continue doing those kinds of adjustments moving forward.
Great. Thank you, Ryan. Now I'm going to turn it over to Jeff, and Jeff's going to discuss something that is really important in our business. And that's just that staying fully invested, even during these volatile times, has just been incredibly important toward long-term outcomes. Jeff, you want to take it from here?
Yeah, thanks, Brent. It's great to be able to weigh in here, and I'd like to think that is a picture of me in 40 years when I'm still doing this business, except I already don't have hair. So I think more importantly, Warren Buffett's got so many quotes that I think resonate. But it is one of the core values of the Wealth Stewards that discipline is freedom. And what we mean by that is that accountability matters, discipline in the way that we invest, rebalance, all that matters, and it shows up in different ways. But one of the things we are for you all that allow us to serve you in the capacity of managing money, Brent, if you want to flip forward to the next slide, is a forced disciplinarian of being invested over time. And I've seen this chart in my last 26 years in the business in different capacities. I think what's pivotal here is you're seeing that since 1950, over the last 75 years, if you stay fully invested in the S&P 500, which is, again, U.S. large cap stocks, your average annual return is 8%. And for most of our clients, if you could sign up for 8% returns year after year after year and know that they were coming, we would all do that. You'd double your money sooner than every 10 years. It'd be a nice trajectory of compounding wealth. It'd be a great, great thing to do. And yet, out of those 75 years, which approximate to almost 19,000 trading days that the market is open, if you miss 75 or the best day of the year in each of those calendar years, you miss less than 1/2 of 1% of the trading days, and you miss out on 44% of the overall return. So your return gets cut down from 8% to 4.5% by missing the best singular day in each of those calendar years. Now, would that happen for anybody individually? No, but you can see the magnitude of the point by doing an extreme exercise. Now, let's take that a little bit further. You miss the best 5 days out of the year, each year of 75 years. Now, by missing 2% of the trading days and being out on the wrong days, we've now gone from a positive return to a -1. And if you want me to show you what a chart of negative compounding at 4.5% a year looks like, I will do it. You're not going to love it. And then again, if you miss the 12 best days of the year, the 10 best days of the year in 75 consecutive years, it's just disastrous. So one of the things we like to say is that we are a circuit breaker between the emotional decisions that people make and their money. And in years like this or compressed time periods like the month of April with all we've been through, we like to think that really stands to be a benefit for you all. And we're happy to take all of the calls and all of the comments and all of the questions as they flow as a result of volatility that has spiked, unlike we've seen in the last 5 years since COVID. So hopefully this gives you some comfort in the long haul. Obviously, the long haul means different things to each of you on this call. And I hope that we blend the discipline of the long term with the uniqueness of your individual scenario to make sure that we're listening and responding and investing appropriately. But don't miss that, 75 days out of 75 years ruins your return and almost makes it not worth investing. So if we can move to the next slide. Now, this is another data set. This goes back to 1928. So now we've got almost 100 years of data, including the Great Depression. And I think what's so interesting here is what you're seeing in the bars on the chart here is different scenarios of yearly outcomes for the S&P 500 over the last almost 100 years. And so on the left side, we start with years where the S&P is down 30% or more. And you can see the frequency of that happening over the last 97 years is only 3 times. There have been 3 years where it's down between 20 and 30, 14 years down 10 to 20. And then as we move to the right, you see there are 9 years where returns of the S&P are 30% or better. Now, when you take this data together, you're like, okay, I think I get it after your last slide, 8% annual returns if I stay invested. I think what's really important is if you break down this data, out of the last 100 years, 2/3 of the time the S&P 500 is positive, and 1/3 it posts a negative return. And so, if 2 out of 3 years I knew that I was going to get the benefit of positive returns, and that third year I had to stomach some volatility and some downside and give some back, along the way to the overall objective of getting somewhere near, those 8% rates of return, if I had a relatively longer time frame, I would sign up for that because I could stack way more wins than losses. And after all, for most of you, what you are looking for us to do is to stack wins and mitigate losses. And I hope the return numbers that Brent shared with you at the beginning of the presentation, showing what we did, the short-term outcome of that, and how it's played out to your benefit, is certainly something to attach to this for the long term, to connect the two and say, listen, if I can have a team that does a really good job of looking out for my best interest, understanding that there are times where changes need to be made to respond to potential volatility, and then keeping me in the game for the long term for these compound returns, well, I would hope that that's a decent formula for continuing our work together and perhaps even expanding it. So I'm happy to weigh on these things, and we'll do, just as a note to everybody, I'm monitoring Q&A as well. So if there are any questions related to these slides or anything else as we keep going, use the Q&A function and we'll address them after the prepared comments. So Brett, back to you.
Thanks, Jeff. Appreciate that. Now, one of the things when we made this move here that was very important to us is really what's the opportunity set that we have for all of our clients. And where we came from, I feel like we were able to offer some fantastic solutions, but the world that we're in right now is much, much larger and quite frankly, I think a lot more interesting in certain ways. When we talk about private markets, alternative investments, these can be in some cases used interchangeably. Every one of our clients now that are trading according to the models that we've put in place, and I do want to backtrack and say, particularly in taxable accounts, there are some very clear reasons why we haven't been able to make giant wholesale changes right away, because the tax man has something to say about this as well. But we're 10 to 15% in this alternative world now in our portfolios. It's been very advantageous to be in that place so far this year because our alts portfolio has been slightly positive year to date as well, even given the volatility we have. But when I talk about private markets, I'm talking about something completely different. In this country, again, amazingly robust, amazingly dynamic, literally 99% of the companies that are out there, of the businesses that are out there, of the opportunities that are out there are not publicly traded stocks. They're not fixed income or bonds that are trading in the public markets either. It's these private markets, and they create an enormous amount of opportunity, we believe, for our clients. Now, with that in mind, the capabilities that we now have at our disposal relative to where we were even, a little bit more than a year ago now are dramatically larger. And so what it became really important for us to do is we've got alternatives incorporated throughout all of our portfolios, but we really wanted to expand on what some of these private offerings were. Now, it's a very big world out there, and you need some guidance to help you do that. And so, what we've done is we've partnered with a company called Case Advisors. You don't need to know who they are, except that they're one of the largest alternative platforms that's out there in the universe. And we've got other ones as well, but this is who we've chosen to partner with on a very, very deep level. So, another name I'll throw out there, which some of you may know, others don't, but Mercer Capital is again a massive company that does due diligence and capital market assumptions. It works directly with Case. And so, what we've done with Case is we built out these private market investments that are available to us that basically have a targeted outcome. So if we're looking specifically for income, well, we could be looking at the private debt space for that. If we're looking for income plus a little bit, we could also be looking at private debt. We could be looking at the lending side in terms of real estate. If we want to build out a balanced private market portfolio, and again, this would never be anyone's sole total allocation, but we really think it incorporates nicely with our existing portfolios, then maybe we roll in some private equity on that. If we're looking for a pure growth story, then private equity creates an enormous amount of opportunity to find that. And I will say that what we've done here and what we're building with Case, and which we're ready to launch very soon, there's very, very few teams in the entire country that were as forward-looking in what we wanted to build as we have been at the Wealth Stewards. When we first reached out to Case and some of their competitors a couple months ago and described exactly what it was that we wanted to do, they thought it was a really fantastic idea and have actually adapted solutions to help us build what we wanted to build on behalf of our clients. So, the bread and butter of what we're always going to be doing in here for liquidity reasons, for tax reasons, for a lot of different reasons. Of course, it's going to involve the publicly traded markets, but there is an amazing, vast world out there of investable assets that in many cases offer, in some cases, very good returns without a lot of the same volatility. Now, there's detractions, there's negatives to some of these markets as well, but we're spending a lot of time and a lot of focus looking at these markets and looking at how we can bring these solutions to our clients. And so with that, I'm going to turn it over to Jeff for some Q&A, but first, because I've got to do it, we're going to pop on that disclosure sheet, and then I'm going to turn it over to Q&A, and Jeff, you're going to MC this for us.
Here I am. I'm sure everybody was excited to read all those disclosures. You'll see them if you want them in depth in the follow-up, which we will send again because this is being recorded. So not a ton of questions so far. If you do have a question, again, there is a Q&A feature on the menu bar at the bottom of the screen that you can submit those questions, and we will answer them live for whatever duration we need to keep flowing through this to get the answers out that we have. And we don't have an answer, I think we'll be pretty transparent that we'll get back to you on that. So let me dig into the first one that came in. And it came in reference to, sort of volatility and what we've been experiencing when we're talking about the markets year to date. The question is, aren't we at an inflection point with the beginning of a huge technological shift as a result of AI and quantum computing, suggesting that history may be a bad teacher? Thoughts?
I'll add in on that. I'll have a couple comments about that. Whoever launched that question, I would agree with that. I think that we're at a massive inflection point in the economy in terms of what some of these technological changes might mean to every single industry. What we found through history, and I don't believe that this point is going to be different, is that what each technological advancement has done, and I don't think that AI and quantum computing are going to be any different, is it's unleashed human capacity for creativity away from the drudgery. I know that the ways that we use technology here at the Wealth Stewards has made us far more efficient in doing what is the highest, best use of our time, as opposed to some of the mundane, repeatable tasks. Now, the question then becomes is what, we're dealing for the first time with a technology that may have its own level of creativity and its own set of agency. And I think that there's something to be said for that. However, having used a lot of these tools and experimented with a lot of these tools, I can say that what they're very good at this point is categorizing and organizing data. They're good for prompts from the creative standpoint, but they're not there yet in terms of replacing human capability across the spectrum of things. So my answer to this is I think what it's going to do is going to create remarkable efficiencies in the economy. I think it's going to create the opportunity for for human beings in the United States in particular, because we are a leader in that space, to quite frankly launch solutions and create products and services that are going to be mind-blowing to us, and hopefully I'm confident they will lead to a way higher quality of life in the long term.
Ryan,
Yeah, I would.
you
The only
came
thing
you
I would
came
add.
off mute, so I took that as a signal that you had something to say.
Yeah, the only thing I would add to that is I think, yeah, that is correct, and I think the market is forward looking and pricing some of that in, and I would argue that's a big reason why you've seen the U.S. outperforming at the levels that it has historically. I don't think that's um, really going to be a negative for us, since we are all, more domestically allocated than foreign, and have maintained that even with the reductions we've made. So that's all I would add to that.
Yeah, and what I throw in from my standpoint is I'm sitting here like I'm literally looking at a company like Tesla, which, right, a miraculous company we've all watched, right? You would say a company like Tesla has been on the leading edge of adopting technology and probably will continue to do so. But, the current price that you pay for a stock is one of the most important contributors to the outcome of owning that stock. And so I don't know where Tesla's going to go, but I do know Tesla's trading at 167 times its earnings. And so what do you say to yourself? You say, well, is Tesla expensive? Yeah, it is, unless it can grow its earnings, significantly to bring it back to what an S&P normalized multiple is, which is not 167. It's closer to like 20, and even 20 is a little bit high. So I think the question is absolutely appropriate and right in that, there's a shift going on. And yet, there are winners and losers. That's what capitalism does. And so I think one of the things that we've found comfort in is like, where is that tipping point where we think, and those that we rely on to help us think, feel like, whoa, like this valuation scenario is way ahead of its skis. And thinking that isn't to negate the premise that it's going to change the way everybody does business. There are concrete examples in our practice over the last 6 months about how AI is changing what we're doing. And that's going on everywhere. So I think we've all sufficiently sort of agreed with the premise. And then the question is, what are you doing to, adapt to the fact that that's an ongoing implementation in the world that we know? Um, Let me keep going with another question that I think comes in. What in private equity stocks, how do you determine how well managed they are? Asking because level of trust in all things institutional has been rocked by different factors, including political, geopolitical, all those things. So, how do you, in particular to private equity, how do you even judge what a good private equity offering is? How do we look at that? How is it, thought about amongst, the team and the people that we rely on to help us with these things?
Yeah, I'll start with that one. So when you enter this world, I think a great analogy is, particularly if you're looking at these kind of investments, where we came from, we were in a we're in a pretty nice apartment building, but with very limited access. And now it's like, imagine you're a cat that lived in that environment. And now you go outside and there's trees and there's shrubs and there's squirrels. Well, it's really amazing and exciting, but there's also cars and trucks that could run you over. And so you have to make sure that you're doing an enormous amount of due diligence. Like any other investment, the companies that are really have this focus on private equity, there are teams in place, there are companies in place that they live in this world that have incredible track records of going and diving deep into these type of investments. What makes them a little bit different as well is that if you have a good private equity manager, someone that's looking at some of these investments, there's a couple things happening. First, where your average mutual fund out there might have 70 or 80 different companies, a lot of these are much more highly concentrated. So and they're smaller companies. So you can actually get under the hood and get a much closer look of what some of these companies look like. The other thing that was really important to us is when you start talking about these private markets, there can be, you don't just want to all of a sudden set loose and say, hey, this is where we're going to go, because without doing the proper due diligence. One of the reasons we partnered with Case is, again, if you don't know who Mercer is, just Google them. You'll get an idea of the size and scope and scale. It's actually who Raymond James went to for due diligence in capital markets as well. But they're also advising Mercer, and they're completely neutral team doing due diligence on some of the offerings that are there available for the Case. Case is involved with us on the advisory side, looking at these deals. Our back office and compliance and tech partners over at Concurrent are also adding and doing some of that due diligence. So I think it's like anything else where you don't want to necessarily chase the nice shiny object. There has to be a real reason for it, and you've got to do your homework on the front end before you even consider some of these investments.
All right. Ryan, anything there? Sorry, you came off mute.
Yeah. No, I think Brent did a great job explaining that. And I think what you would take encouragement in is that we're not relying solely on our own intellect and ability to go through that process. And you don't have to just trust Brent, Jeff, and Ryan and the team are going to be able to do this and go through these financials. You've got multiple layers of individuals well qualified, doing a lot of that research and due diligence as well in tandem with us. So I think that's important and a good takeaway that should boost the confidence of the investors.
Yeah, and I think if anybody is interested in a robust deep dive into due diligent processes on different product sets or whatever, that is certainly beyond the scope of the time we have here, and because it's a complex answer, there's a full answer that we're happy to dive into. So let's pivot a little bit off that. And another question, which is, what indicators do we use when there are significant market shifts to help make asset allocation decisions?
In terms of overall economic indicators, Jeff, or are we talking about swings in the markets?
Yeah, so where are we getting the ability to think about, alter, update, manage, how do we make changes? Where are we pulling information from to help inform us when and how those things might be considered and then implemented?
Yeah, so I'll dive into that too, and definitely feel free to jump in and expand on that. So in the world that we're in right now, one of the great things that we have is we have the opportunity to collaborate with a lot of other companies. And those of you that have joined us for these town halls, I think it was Q3 into Q4, we spent a lot of time talking about a firm called Fiducian Advisors. And what they do for us is they help us act in many ways as an external CIO, where they are living in this world of capital market assumptions, and they're doing, again, also an enormous amount of due diligence for us as well. And so there's a couple ways to answer that question. Is one, has the economic landscape and the market landscape in the world shifted enough where we don't think we should be, on a relative basis where we've been in history, have an overweight bias towards some international markets, again, relative to where we've been in the past? That's not just going to be Ryan and Cyrus and Jeff and the rest of the team in here or myself that are making that decision. There's going to be a big conversation and dialogue that happens with us. We meet monthly. We meet with Fiducian on a quarterly basis, talking about what may be evolving in the market. The other part of that, I think, is when you see these really dramatic volatility swings that have been occurring, is there's a certain amount of, without getting too kind of wonky technical, of drift that occurs in these portfolios. And you want to be very careful about making reallocations and shifts based on that day-to-day volatility in the short term, because in many cases you can get kind of caught on that. But if some of these imbalances persist for a longer period of time, again, probably beyond the scope of our conversation, but we've got drift measures in place in the portfolios that will trigger us to rebalance at that point. I don't know if that's where that question is going, Jeff, but that's maybe a two-part answer to that.
Yeah, I mean, what I think, my answer to that would be is we have quite purposely built thought leadership around us that leverages and expands our ability, right? I've been in the business over 25 years, Brent as well, Ryan and Cyrus, right? Over a decade, trending towards a couple decades. And so, on one hand, you'd say to yourself, okay, well, you guys have, all this capital in here and you have ideas and there are fundamentals of investing. Sure, like we could pick stuff, and we do. But I think the key is the ability to vet ideas through a bigger engine and a more robust system than our own. And Fiduciant does a lot of that work. Again, in a prior call, we talked about some of that platform they use and the technology and software that they have to help us vet those things. And I can tell you, like, if you want to know how that's going, uh, a lot of the ideas for what the robust changes we made at the end of last year into Q1 were guidance from Fiduciant advising to people like us and institutions on $500 billion, showing us the evidence for why that seemed to make sense. And so we're going to continue to use that as a tool, as well as our experience, as well as peer group sharing and tapping into the co-op of concurrent that we've hitched our wagons to. There's no one solution. But we do have a job to come up with a set of solutions for you all that get the job done. And that comes from a lot of different places. So hopefully, Brent, if you have something to add there.
Yeah, just one last thought with that. I think with any business or even any group that you have around you, there's always a danger of creating an echo chamber where, I'll say something and Ryan says, that's a great idea, and Jeff says it's a great idea, and vice versa, where we have surrounded ourselves very intentionally with other organizations and people that will continually challenge what our thesis is and our idea set. And that goes back and forth. And so everyone has to be willing to defend some of these ideas we're bringing to the table. And so there's an ongoing dialogue that we have.
Yeah, it said differently, we have brought some dumb ideas to Fiducian.
Yeah, where they're the guys here that no, we're not doing this. It's a mistake.
No,
Do
we're
that.
not
We
doing it.
don't advise you do that, and here's why. Yeah.
Yeah, but also in your portfolios are ideas that we brought to concurrent that when we showed them what we thought, why we thought it, they saw value in it. So the ultimate authority and ownership is on our end. You're not going to call Fiduciant for your portfolio returns if you like them or don't like them. That is our job to make sure that they do their job for you all. And so the buck stops here for anybody. Okay, one other question. Um, Great question. Anonymous attendee with an awesome question. So whoever anonymous is, I love this question. And here it comes. Any vision regarding cryptocurrencies for your clients as of today?
I'm happy to chime in on that if you want me to. The question is, an exciting thing is we can actually talk about this now, which we couldn't in our old world. The question is, how do you access those markets? And the crypto markets, it's highly fragmented in terms of the exchanges that these products trade on, and also, there's private keys where you're holding them yourself and everything else. And I was actually had a conversation with Fidelity today because Fidelity is one of the first major custodians is thinking at a lower level. You can do it right now at $5 million or higher, but allowing smaller positions of crypto to be housed on Fidelity. And that's kind of an ongoing discussion. Now, that noted, there are other ways where you can use the public markets, things that are trading right now, away from direct access to crypto, where you can get that exposure. And that was something that we brought in our quarterly meetings with Fiducian in Q4. We brought it to them again in Q1. And in Q4, we're looking at it, not sure. In Q1, we're looking at it, and we might have a little bit more of an appetite to make the appropriate argument in terms of incorporating perhaps a small amount of that in portfolios. Now, we've not collectively made the decision to do that yet, but it is an ongoing discussion for sure. And it's somewhere on the horizon. Whether it materializes or not is something we're still trying to determine.
Great. One other came in. Decent question. And I'm going to reframe the question a little bit, but it's a great question, something we're actively working on. So I love that somebody asked this. Can you talk about what you have done to improve income generation, or maybe more generally, I'm sort of teeing the question up, what we're looking at for retirees and income generation already? What's in the pipeline? How are we thinking about it? Anybody who wants to weigh in? Brent, looks like your head nodding, so I'll start with you.
Yeah, so that's again another thing. So it's a complicated answer because it depends on what the liquidity needs and a lot of the other needs are of the existing clients. But today in this private market space, we've not made a decision yet whether we want to incorporate these into portfolios. But again, we're looking at a real estate opportunity to generate that higher level of income. We have built bespoke portfolios that have deviated pretty significantly from some of our standard models for people who capital appreciation is really a secondary concern for a variety of reasons. The constraint's not what the accounts are doing in terms of upside or downside volatility, but it's the amount of income that's being generated by these portfolios. And so that's to the answer your question, yes. And it's become a need and a desire that we have to be able to, on a broader basis, roll out some of these higher income investments to clients, that it's probably going to be another sleeve that materializes for us as we call them. They're not standard, but as sort of core portfolios for us.
Yeah, I'm going to throw in a broader comment to hopefully anchor to people. And I think, one of the things I see from the financial media or listening to the radio or, all the noise out there, as we would call that, is a lot of there's very enticing sorts of advertisements and messaging out there about the ability to garner high yields and 7%, 8%, 9%. And let me go back to the genesis of where this term high yield came from as an asset class. And it comes back to a rebranding in the 1980s, because high yield is a name for junk bonds, right? So the way that you get a high yield is generally, you buy a lower quality instrument. Okay. So remember that, the devil's in the details, the fine print on commercials, how you get to an end game is really important. And one of the things we don't try and do here is sell the sizzle. Like, we're about the steak, right? And so just watch out for the details of what you see. Now, over the last year, many of the clients here, and perhaps more with this comment, would be interested in looking at boutique, highly customizable municipal federally tax-free bond portfolios yielding, 4 or 5%. And when you do the tax equivalency, a higher number effectively. Those solutions are at hand. What I would say is, I think one of the key initiatives of a build up to where we're not where we want to be in totality here at the firm is a broader solution set for the differential income needs of different retiree clients. And yet, we have plenty of solutions to put that together, and we'll continue to work on that for you. But, I think if the answer is, are those things available? Yes, they're in place. We can talk about them. And remember, the other thing I would throw in here, the other thing to throw in the equation is that, yield is a component of return, right? Yes, yield is important, but dividends on stocks can be cut, and bonds with high yields can default. So there's always a yin and a yang to any sort of sizzle that you see, and we're happy to have those discussions again one-on-one as they relate to you and what you might be considering or want from us or want us to seek on your behalf. Ryan, do you have something to throw in there?
Yeah, just exactly what you just finished with. I would just touch on is I hear a lot of times meeting with newer clients, and we're onboarding, and this comes up often. And a lot of times they're looking for this income, but you're not necessarily spending that level of income. And so it's generating taxes unnecessarily on some of these products, and it doesn't fit. So it's really critical to have the conversation with your advisor, going through why you think you need the income, what is driving that conversation, and making sure you're not just creating a tax burden with no upside. Like you said, it's only 1/2 of total return. The rest of that is price appreciation. So you want to take that into consideration. That's the only thing I'd add to that.
Yeah. Well, listen, there's two things I'm going to say as I wrap up the Q&A portion. One, great questions. This is the point. It is your forum to ask questions that, maybe stimulate other thoughts from other people on the call who weren't thinking or asking those questions. So we love that part of it. But also, I'm looking at the metrics here, and the peak of how many attendees, the peak to trough, if you will, on attendees versus where we are today. We've only lost 3 people in 48 minutes. So I want to thank everybody for sticking around for the entirety of this to hear these questions. And hopefully you found the courage to ask one from these other questions the next time we do this quarterly town hall. So Brent, I'll turn back to you and consider the Q&A portion of the town hall closed.
Yeah, so just want to thank everyone again for joining us. If you've got follow-up, we will have a recording of this. It's going to go out. please feel free to share it with anybody that you think might find this valuable. If you've got questions that you did not ask or you didn't want to ask or that you felt was better asked directly to the advisor you're working with, please reach out to any of us, and we're happy to go deeper into some of the topics we discussed today. And again, our main goal with this is to make sure that you know what's going on here, what our thought process is, and the solutions we're trying to bring to you. And with that, we just want to thank everyone for being here. And I guess, Jeff, we will sign it off.
Thank you, everyone.